Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KKR Real Estate Finance Trust Inc. quarterly report. KKR Real Estate Finance Trust Inc. provides a range of businesses and services focused on commercial real estate (CRE) financing. The company's key offerings include origination and acquisition of transitional senior loans secured by CRE assets, origination and purchase of credit investments related to CRE, including plus leveraged commercial real estate loans, plus unleveraged commercial real estate loans. KKR Real Estate Finance Trust Inc.'s stock price drop. A year of challenges over the past year. KKR Real Estate Finance Trust Inc. (KREF) has experienced a significant decline in its stock price, falling by over 19.61%. Several key factors have contributed to this decrease. The commercial real estate sector's struggles, particularly in office and life science segments, have had a substantial impact on the company. Additionally, KREF recorded hefty loan loss provisions, including a $50 million current expected credit loss (CECL) reserve, which played a significant role in the company swinging to a $35.4 million quarterly loss. The decline in book value per share from $15.24 to $13.84 year-on-year further exacerbated the situation. The company's underperformance against benchmarks, missed earnings and revenue estimates, negative financial metrics, and high debt-to-equity ratio have all contributed to its stock price drop. These challenges highlight the difficulties faced by KREF in navigating the current market conditions. The primary drivers of revenue growth or decline in a financial institution can be identified through an analysis of various key performance indicators. The main contributors to revenue growth include commercial real estate loans held for investment, income from equity method investments, and revenue from real estate-owned operations. On the other hand, interest income, total net interest income, gain/loss on sale of investments, and revenue from REO operations are among the primary drivers of revenue decline. These indicators suggest that a financial institution's revenue is heavily influenced by its investment portfolio and loan activities. The stability of revenue can be attributed to provision for credit losses and expenses from real estate owned, which provide a steady stream of income despite fluctuations in other areas. Net income and profit margins decline. A cause for concern. The financial summary reveals a concerning trend in net income and profit margins for the company. Net income decreased significantly from $14,771 in YTD 2024 to minus $23,550 in YTD 2025, a staggering drop of $38,321. This decline is also evident when comparing the 9 months ended September 30, 2025 to 2024, with a decrease of $15,166. Profit margins have also taken a hit, with net interest income margin decreasing by 0.52% and total other income margin plummeting by 9.2%. The likely cause of this decline is the substantial drop in net income. As a result, profit margins decreased from minus 0.19% to minus 0.56% for the 9 months ended September 30, 2025 compared to 2024. These declines raise questions about the company's financial health and ability to generate revenue. The significant decrease in net income and profit margins warrants further investigation into the underlying causes of this trend. The company's financial performance indicates a strong ability to generate cash from its core operations. As stated in the report, the company is indeed producing positive operating cash flow, which is a crucial indicator of its financial health. The numbers provided on page 83 further support this claim, showing an increase in operating cash flow from $114,241 in December 2024 to $55,548 in September 2025. This trend suggests that the company's operations are generating sufficient cash to meet its needs, positioning it for long-term success. The company's debt level has undergone significant fluctuations over the past year. While the total debt level is not explicitly stated on page 78, individual components such as revolver and secured term loan have increased from $660 million to $700 million and $339.5 million to $650 million, respectively. However, collateralized loan obligations outstanding principal decreased from $1,766,231 to $1,339,000 $324,479. In terms of interest expenses, the picture is mixed. On page 13, interest expenses decreased by $1,344 from 2024 to 2025, while on page 23, they increased by $13,580, 12.4%. However, on page 83, interest paid on senior loans decreased by $64,969 from $308,807 to $243,838. Overall, the company's debt level has increased in some areas but decreased in others, making it difficult to determine a clear trend. Interest expenses have also fluctuated, with both decreases and increases reported across different pages. Management is optimistic about the company's outlook, citing a well-positioned business model that can benefit from commercial real estate financing demand. The loan portfolio has performed well, with a weighted average yield of 7.4%. To manage investments and day-to-day business, the company will focus on originating or acquiring transitional senior loans collateralized by institutional quality CRE assets in top markets. The strategy involves paying a quarterly management fee and incentive compensation to the manager based on adjusted equity and distributable earnings. The investment objective is capital preservation and generating attractive risk-adjusted returns for stockholders over the long term. Management expects to continue scaling the loan portfolio, focusing on originating floating-rate senior loans and financing them through repurchase and other financing facilities. The company plans to expand and diversify financing sources, especially those that provide non-mark-to-market financing, to reduce exposure to market volatility. With a positive outlook and an increase in net income of $43,345, or 142% compared to the previous period, management believes the cash position and sources of liquidity will be sufficient to meet anticipated requirements in both short and long-term periods. The company's financial activities involved several key transactions. On the acquisition side, the company purchased commercial real estate loans, held for sale, and restructured a risk-rated 5 mezzanine office loan in Boston, MA into senior and junior mezzanine notes. In terms of divestitures, the company sold investments resulting in a gain or loss on sale of investments. Additionally, a $35.9 million subordinated note was written off as uncollectible. The restructured mezzanine loan in Boston is listed under both acquisitions and divestitures, indicating it may have been initially acquired but later restructured. The company has a history of rewarding shareholders through both dividend payments and share buybacks. In terms of dividends, the company has paid out $0.25 per share on October 15, 2025, as mentioned in the financial summary. Additionally, the company has also engaged in share repurchases, retiring 3,508,881 shares under its repurchase program during the 9 months ended September 30, 2025. That concludes the financial summary for KKR Real Estate Finance Trust Inc. Feel free to comment below, and I will be happy to answer them when possible.